Ray Dalio wrote an interesting article on what he thinks of the whole Silicon Valley banking situation. And so that's something that I do want to cover in this video. And so, guys, as you smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, Ray Dalio provides a lot of interesting commentary. Sometimes some of his economic commentary goes a little bit over my head, but I do like to read all of the articles that he puts out. He puts out quite a bit on LinkedIn. So if you follow him on LinkedIn, you'll get access to quite a few articles that he puts out all the time. And so what I want to do in this video is I want to do a bit of a read along. I may not necessarily understand exactly all of what he's saying, but I'm going to try and do my best to provide commentary as we sort of read along with his article. And so here's the article. It says, what do I think about the Silicon Valley banking situation? So let's dive into this a little bit further. So he starts with, he thinks that the Silicon Valley banking situation is a very classic event in a very classic bubble bursting part of the short-term debt cycle. And he says that that lasts around 7 years, give or take 3 years. And so I guess we're kind of due because the last banking crisis was in around 2008, 2009. So, add 10, maybe a couple more years, and you're kind of where we are today. And so he says that in this situation where you have the tight money to curtail credit growth and inflation, I would say mostly it's just to curtail inflation. That's why interest rates went up. It leads to a self-reinforcing debt credit contraction, which of course it would, because if interest rates are higher, there would just be less debt taken out. And then of course that potentially creates a domino falling, almost like contagion process, which will continue until the central banks create easy money. And we're kind of seeing that right now where, there are some areas that are in higher risk than others. Like I would say some like commercial real estate right now is challenged. There was commercial real estate companies completely buying properties at cap rates of like 6%. Now they won't be able to refinance that debt at 6%. And so are they going to be earning a negative return on those assets? Well, the longer, we have higher interest rates, the more companies are going to run into trouble, especially in these like levered, low return asset type companies like these commercial real estate type of companies. This also, the banks are running into issues as well. But the thing about the banks is that they can continue to raise rates as their sort of like deposit rates increase. However, what happens when the banks run into a situation where they can't raise the rates significantly higher anymore because their borrowers are now put into these tough situations? So here's where like the whole system can sort of like collapse on itself. And this is what sort of like Ray Dalio is saying. And so the Federal Reserve would eventually have to create easy money. Otherwise, the whole thing goes kaput. And then of course that easy money creates the seeds for the next big debt problem. And so, these short-term debt cycles build up the debt assets and liabilities to the point where they're unsustainable and the whole thing collapses in a debt restructuring and debt monetization. So essentially, if you're holding dollars, you essentially get wiped out. And he says that that happens once every 75 years, give or take about 25 years. So, he's predicting basically like a yo-yo effect until a wipeout and a complete debt restructuring. So far so good. Like pretty much what he's saying makes sense. And I think one of the best ways to sort of hedge yourself against that would probably be have a diversified portfolio and extremely strong, very value added for society businesses. And so let's continue on and see what he's saying in this article. So he goes on to say that because A, we're in the early stage of the contraction phase of this cycle, and B, the amount of leveraged long holding assets is large, it absolutely is, it's likely that the bank failure will be followed by many more problems before the contagion phase of the cycle runs its course. And I would say that I would probably not have predicted bank failures first. I probably would have predicted issues in sort of like the commercial real estate market before the banks failed. But it's interesting how we're seeing it backwards, at least for some banks. But I think you'll see many other banks run into sort of like bank failure type situations once it sort of gets revealed that their loan portfolios are not as diversified as you initially thought they were. And, especially if you start having problems in that one area that I continue to mention. And so he goes on to say that before the contraction phase of the cycle ends, history and logic has shown that there will be absolutely forced sales of assets at very low prices. Now, there was actually an article on the Wall Street Journal of how one commercial real estate property, and I showed this to the Patreons yesterday, is actually looking to be sold sold at 20% of what it was selling for just a few years ago. So you're absolutely already starting to see for sales of assets at very low prices. Two, there will be equity dilution. In other words, selling at prices that are significant discounts to conservative estimates of the present value of their future cash flow. So third, there's attractive acquisition prices for strong synergistic companies. And this is where value investors can really sort of make some real gains by buying distressed companies and distressed assets. So, if you don't know much about distressed investing, I would start looking into that now, because I think some opportunities are coming. This is the main reason, actually, why I've been so conservative in this environment. I haven't really been deploying as much capital as what a lot of other people have been doing. I started selling a lot of the positions late in 2021, sort of like selling into the strength. And I've been telling you guys for the last year that I've been sitting on a lot of capital. And this is why I've kind of been sitting on a lot of the capital, because, I'm waiting for the valuations to come to me. And if they don't come to me, it doesn't necessarily burn a hole in my pocket. And so, let's see how this continues to play out. I'm not waiting for a huge material decline of the whole economy or anything like that, but there's areas where we could see some opportunities. Right now, we're seeing that opportunity in the banking space. And, I'll show you guys later on how I analyzed 63 banks. And I actually came across, I would say, at least 3 or 4 banks that are safe and are providing me with, an equity yield of around 15%. So that's not a bad place to start. Now, for credit problems being negative for markets and the economy, and of course, that will eventually cause the Fed to ease and provide easier credit and essentially, guarantee that the problem doesn't become system threatening. And right now, he believes that at this early point in the contraction, it's too early for the Fed to ease. And so he's going to be watching this, but he believes that looking ahead, it's likely that it won't be long before further problems pick up, which will eventually lead to the Fed and banking regulators to act in a protective way. And you've kind of already started to see bits and pieces of that. I think you're going to see it again with a potential bailout of First Republic Bank. I released a video earlier today about that. And so, I think you're starting to see the early stages of this already. And so he goes on to state, how did these cycles go? Well, when the debts are in a country's own currency, essentially you can monetize that debt. That's really what happens. And essentially, he's saying it here that the central banks can create enough money and credit to fill the funding gaps. And so the real question is, at what cost is money and credit being created? And so this is where the bigger long-term problem is. And it's that the U.S. central government has large outstanding debts and is selling more debt than there's demand for, and central banks are monetizing the debt. And so controlling the problems is financed by central bank printing money and buying the debt. So in other words, the biggest buyer of the debt is also the largest seller of the debt. So you almost have like this house of cards, and the offset to this transaction is, of course, inflation. And here's where I might be misunderstanding Ray Dalio. So you guys let me know in the comments if I'm interpreting this correctly. But he's saying the really big problem will come when there's too much of this money printing to provide creditors with real adequate returns. And so with the enormous size of the U.S. debt assets and liabilities outstanding, plus lots more to come, there's a high risk that the supply of government debt will be much larger than the demand for it, which will cause too high real interest rates for the markets and the economy, leading to debt and economic pain that will eventually lead the Federal Reserve to switch from raising rates and selling debt, quantitative tightening, to lowering rates and buying the debt, essentially quantitative easing. And so, so in other words, the government will be the largest buyer of government debt. So that's that house of cards that I was talking about before. And so, I think that, or he says that, I think that there's a good chance that it will produce a big decline in the value of money. And so it's likely to me that the financial economic picture over the next year or two will be tough. So the way I'm interpreting this is that because they'll effectively switch to reducing the rates and going back into QE because the problems build up, we essentially just have more and more inflation. And so what ends up happening is that I think these cycles get a little bit faster. That's kind of how I'm interpreting it. The cycles get a little bit faster, but we have a higher rates for longer. I want to know what you guys think about this. You know, and what I mean, we have higher rates for longer is like we have higher rates and then they get lowered, and then a couple years later they get raised a little bit more because we have inflation, and they might get lowered because we run into problems, and then so on and so forth, and we just keep going along this path. Now you guys let me know what you think, what you see coming, because I may be completely misinterpreting this. Now the other part that Ray Dalio brings up is it's very relevant, is that there's a bunch of external issues as well. So he's saying that there is an internal conflict dynamic, which is more like related to the US elections that are coming up, but there's some external conflict dynamics as well. For example, the US-China conflict that continues to heat up. I eventually think that they're not going to do anything. I really hope they don't. And then of course the US-NATO-Russia conflict. And so, you know, this setup implies to him that there's a significant risk here that there will be one, bad financial and economic conditions, and two, there will be bad internal conflict, and three, there'll be bad international conflicts, with the world being leveraged long. In a nutshell, it looks to Ray Dalio like the next 2 years will be a very risky time, and I don't disagree. But I would say that it's not just the next 2 years, it's probably the next 20 years or so. Like, I just think there's a lot of risk just because where we are in the cycle. And so, you know, the key to good investing lies in achieving balance of uncorrelated good return streams so that one's portfolio has little or no bias to go up and down as conditions get better and worse. And so he's right. And so essentially what he's saying is that, as he stated repeatedly, there is risk reduction that can be done without reducing expected return. So that's what I think and what I recommend doing. Now, I obviously don't provide recommendations, but I think the more diversified you are, the better it is ultimately, because you never know. Like, at least in my history, you know, my investment history, it's oftentimes the asset classes that I think are not going to do the best end up doing the best anyways. And so it's important to be diversified, not just with equities, but also outside of your equity portfolio as well. And so, like, I agree with him. I'm not going to recommend for you guys to do anything. You guys decide with your investment advisors, but I do agree with him that diversification is key. And, you know, what exactly has the Silicon Valley banking situation done? Well, you can see that the KBW banking index has actually declined 31% over the past year. And so my question is, are there opportunities in the banking sector in this decline? Well, here's where it becomes really difficult, because in order to analyze banks, you really have to analyze them on many key performance indicators, but then you also have to dive into their financials and really determine what makes the bank different, what do their loan portfolios look like, what did their deposit base look like, you know, where are they located, et cetera, et cetera. There is just a ton of analysis and information that you have to get before you can decide, you know, like what bank you'd want to invest in. I always recommend for new investors to just stay away from financial institutions as a whole, because it's very hard to determine which one is right for your portfolio. And so this is why, like, I always say that, like, unless you have many years of experience, this area might not be for you. And so what I did was actually, like, during my time away from YouTube when I was sick, I actually analyzed 63 national and regional banks, and I actually hope to add another 40 more to this. And what I did was I compared them against many of the key performance risk indicators, or sorry, many of the key performance indicators and risk indicators. I don't know why I said Rick there, including the 9 above here. And what I essentially did was when I compared all of them using those 9 indicators, and then I ranked them, I went into each one of those, like, highly ranked banks, and I determined which ones I thought were most appropriate based on the risk reward and the opportunity that was present in the current environment. And then after that was done, I actually put on a special course for the Patreons where, you know, we reviewed the key performance indicators for the banks. We applied those key performance indicators to the banks as we analyzed them, and that was essentially the ranking system that I did. And then I actually provided my personal rankings of the banks that are analyzed by understanding exactly what the story of the bank was, where the risks lie, what is the loan portfolio composition, what do the depositors look like, where geographically the bank is, how geographically diverse their portfolio of lending is, et cetera, et cetera. And so there was a lot of analysis done here. It's a very long video, but I think it's one of the best pieces of content that I've put out on this channel. And of course, this is a video that's available to the Patreons. And so the question is, how do you get access to this analysis? Well, you can get access access to the special live courses and the comp schedule where I analyze the banks at the higher tier of the Patreon. And you also get access to a monthly live economic call where I present a research presentation and, I do it live and I discuss what opportunities I'm seeing in the market, followed by a Q&A. But, of the 200 Patreons, many of them are at the lower tier, and at the lower tier you get access to my research tracker, which I show all the time on this channel, and that has models for many companies like Alibaba, Alphabet, etc. And so there's a lot of value here, but I'd say the best value is in a higher tier. And of course, I would say that the best free value on this channel is that Q&A series where I answer some of the hardest questions that you guys give me, or cover really complicated topics that I'm not seeing being covered at that level of depth on YouTube. And so in order for you to get access to that Q&A series, you can get access to it right here.